About 3 weeks ago, Jay Powell, the chairman of the Federal Reserve, announced that it was, quote, premature to conclude with confidence that we have achieved a sufficiently restrictive stance or to speculate on when policy might ease. That's Fed speak, and in case you're not familiar with it, that means we plan to keep interest rates high. Okay. Then last week, 2 weeks later, with no warning at all, Jay Powell seemed to pivot dramatically and say almost the opposite. Actually, he said, cutting interest rates is something that, quote, begins to come into view and is clearly a topic of discussion out in the world and also a discussion for us at our meeting today. In other words, we are lowering rates. So many people who are paying attention concluded that this was political. Joe Biden is losing the race and the Fed is trying to save him. But what is even worse than that? What if it's not just Joe Biden they're trying to save, but the U.S. economy? What if the fundamentals are so weak underneath that the Fed is desperately scrambling, groping in the dark to figure out what to do? You have to think that's possible. The Fed is supposed to be stable. That's why they speak like 19th century jurists, to convey stability. But if they're changing their mind on the biggest question that they address in 2 weeks, one direction, another direction, that suggests chaos, and that's bad. For an informed guess on what exactly is going on, we turn to Jeffrey Gundlach. He's one of the most famous investors in the country. He's founder and CEO of Double Line Capital. Mr. Gundlach, thanks so much for coming on. So to Powell's apparently contradictory announcements just a couple of weeks apart, a lot of people looked at this and said, well, you know, it wouldn't be the first time the Fed responded to political imperatives from the White House. Do you think that's what's happening?
I don't think that's the primary factor that's going on here, although it is interesting that pivot that you mentioned is so radical.
Yes.
I think that what's going on is that interest rates have fallen at the long end of the maturity spectrum. So 10-year treasuries, 30-year treasuries, and they've fallen to the point that they're well below where the Fed has short-term interest rates. And the Fed almost always takes notice of that. And it's gotten to be pretty extreme. And so that's one of the major factors, I think, that they're aware of history and the way that the interest rate cycle works. So I think that's a big piece of it. I also think that the Fed is noticing that the inflation data is moderating to a point that's getting close to what they hope to achieve. What I mean by that is there's all these different inflation indices, the CPI, right, the PPI, the PCE. You can almost pick any one you want. But if you look at the one that the Fed uses the most, which is the PCE, personal consumption expenditures, if you take a look at recent months and annualize them, they're basically right at the Fed's target. And so inflation went up much faster than they expected back a couple of years ago. And they were tardy in raising interest rates. They should have raised them much sooner. So inflation actually on the CPI got to over 9% on the high, which is sort of Jimmy Carter-esque.
Yeah.
And so they had to go into radical interest rate increases. But one thing that is lurking beneath the surface, and I think this is the primary variable, is there is an enormous amount of debt that the Treasury has to refinance over the next 3 years. There's $34 trillion of national debt, which is shockingly high. And it was facilitated by the fact that the Fed kept interest rates at zero for such a long time.
Yeah.
When interest rates are at zero, you can borrow an infinite amount because you have no interest expense. But all of a sudden, interest rates are up by 5 3/8% or 5.5%. And now we have $17 trillion of Treasury debt that's maturing in the next 3 years. And if interest rates stay there where they are, it's going to cause a tremendous squeeze on revenue, because already we have a high percentage of interest of tax receipts that go to interest expense, and it would go much, much higher. The CBO, the Congressional Budget Office, projects where deficits are going and where interest expense is going and all that stuff, but their assumptions are no longer really valid. They assume that the national deficit will be at around 3 or 4% of GDP. Well, it's already above 6% of GDP, and we're not even in a recession.
Right.
They also assume that interest rates will stay at around 3 or 4%, and they're starting to get to 3 or 4% type of level, but they were up at 5.5% or 5%. And if you just do the arithmetic, you start to realize that the percentage of tax receipts that will go to interest expense becomes completely untenable. In fact, if you assume that we continue to have 6 to 8% deficits percent of GDP, which is almost a certainty the way this economy is running, and you keep interest rates where they are, it's in about 5 years, you have something like, it depends what interest rates you assume, but you have something like 30, 40, even potentially 50% of all tax receipts going to interest expense. This is a really big problem because we have such a large amount of expenditures that are mandatory. We don't have the money
right
to have interest expense that high. And so I think beneath the surface, the Fed is looking for reasons to say mission accomplished in a certain sense by taking the last 3 to 6 months of inflation data, annualizing it, and saying, well, maybe we don't need interest rates this high, and maybe we have to worry about this problem. Also, I do think that it is typical in a presidential election year, this is that secondary variable that you brought up, where they just don't really want to change things very much. And so the Fed has gotten to this place where they want interest rates to sort of stay where they are. They're clearly not talking about hiking them anymore, and they may cut them depending upon what happens to the inflation data and ultimately the stock market. The stock market dropping is really the thing that is the straw that breaks the Fed's back when it comes to giving up on maintaining higher interest rates. You might remember back in 2018, we had a meltdown in the stock market in the fourth quarter. That came about when Jay Powell said we're going to have interest rate increases on autopilot, and we're going to continue to buy back some of the bonds that we have on our balance sheet. We're going to let them go back into the market. And the stock market dropped like 20% in a few weeks. And suddenly the Fed did a complete reversal, even more radical than the rhetorical pivot that they did in the past several weeks. They just suddenly started slashing interest rates down to zero again. So one thing I want to point out is the world has fundamentally changed because of the zero interest rate policy.
Yeah.
You know, we have all this debt. It was made possible by zero interest rates. And in the past, decade after decade, when you had low unemployment, you had low deficits. And that makes sense. When there's low unemployment, you don't have to pay so much unemployment benefits. You have higher tax receipts because more people are employed. But starting in 2015, something changed. We've had low unemployment since 2015, and yet the deficit has been rising since 2015. This is unprecedented to have a rising deficit with what's considered to be close to full employment. So we have a debt-based economic scheme. The deficit as a percent of GDP is running at above 6%. People talk about this as a good economy, but if we actually didn't run a budget deficit, if we had a balanced budget, GDP would be negative over the last 12 months. And so this is the fundamental problem. And I think that's factoring somewhat into the Fed's logic, but it's not tenable. We cannot keep going on.